Good morning, everybody. It's Max Convexity. Welcome back to my channel. This is the Daily Covered Caller, which is my daily show where I talk about these covered call funds and other stuff and kind of the market generally. All right, guys. Well, today we're going to start off with, we're just going to take a look at a little bit of everything, but let's start off with Defiance, of course. Okay, so here we go. Let me make this a full screen. Start with Triple QY. All right, so these guys sold options on Friday. They sold 103 of them for the 19,550 strike price, and that trade is still alive. They don't expire till Tuesday. They sold them Thursday, and they expire Monday night, so they won't put on a new trade till the end of the day today. This trade's still alive. They do this usually once a month on options expiration Friday, which I'm trying to think, which I think it must have been last Friday, because that's when they do it. So what was last Friday? 18th, 17th, 16th. I guess it was the 16th this month. It's a little bit earlier than it is some months. It's the third Friday, right? 7:40. Anyway, all right, guys. So right now, if they sold the 19,550 strike for $154, they need the price of NDX, which is what they trade, to be over 19,550. Well, here's the current price right here. It's at 19,576. So it's 176 points above. So it's not in the money. So we'll put a 0 there. Right now, they're going for 1.5 million. They're actually realizing 1.5 million. About $200 million under management. Earnings per share is a killer, 71 cents. They're just killing it. Oh, actually, I figured out something wrong. I'm calculating earnings per share wrong, I think. No, I'm not. I thought I was using the old share count, but I'm using the new share count. Okay, earnings per share is right. I'm calculating the dividend two different ways, with the old share count and with the new share count. With the new share count, this thing's going to pay around a $3.76 for a dividend. On the old one, it's $1.25, or the pre-split price. The only reason I like to compare a pre-split is because we have a feeling, for what it should pay. So Triple QY, in my opinion, a good month is 80, 85, 90 cents, maybe $1. So let's look back at some of the past months. They paid 62 in January, 62 in December, but 85 in January. That was a great month. 80 in February is a decent month. 79 cents in March, 86 cents in April. April is a great month because the market pulled back and volatility went up. Everyone thought these funds would do worse when the market pulls back or would have some kind of problem, but it's actually opposite. Their dividends go up. So then you have May, it paid 80 cents. June, it paid 65 cents. I haven't put July's in here. In any event, I'd say $1.25 is humongous. Freaking humongous. All right. Now, that's just an estimate. Don't go out and buy it just because I said that. It's not a get-rich-quick scheme, but if you've been watching me for a while, these might be funds that you could allocate to your portfolio, meaning you spend 1% or 2%, maybe of your overall portfolio on a fund like this, and you earn some income. And I would say no more than 20% on all of these covered call funds. The reason I say maybe 2% is because you aren't going to put all your money in one fund, right? Of course not. So let's say 10 funds. So just kind of arbitrarily, 20 divided by 10 is 2. So at the most, I can't see somebody not wanting. There's like 100 of these funds out now, and there's like 20 or 30 of them that are awesome. So I just can't see not putting 20 of these in your or 10 or 20 of these in the portfolio. If you put 20 of these in the portfolio, it'll only be 1% a piece, and 20% overall. But yeah, these are badass funds. All right, so. But they're for allocating. They aren't for trading. They aren't just because it pays a huge dividend. People think that because the dividend's 50%, it's going to make 50%. No, it's two different things. The dividend's 50%, and it might make 50%. It might make more. It might make less. But total return is totally different than yield. All right. So these guys sold the 55.65. These guys actually sold a new option Friday, and it expires tomorrow. They got 18.60 for it. Well, first of all, their option on Friday expired worthless. So they made 381 on Friday. They're going for 340 right now. The current price of the market is 55.79, and they sold the 55 what? 65. Uh-oh. So what does that mean? That means they're a few points in the money right now. They're going for 340,000, but they would have to pay to cover this right now. Well, maybe not. Maybe I did my math wrong in my head. Oh, no, I didn't. Just a second. Apologize about this delay. Let's get this formula right. Paste formula. And that still says here, okay, so something's wrong here. They sold the 55.65 strike. So that means they want the market to be above 55.65. Okay, and it's 55.79. All right, so it is above. So that is right. I'm sorry, my bad. So they're making 340,000. Easy peasy. All right. Earnings per share is 87 cents. And that's pretty damn impressive, but it's even more impressive when you consider they were down $1.38 a share not too long ago, a couple of weeks ago. I mean, this thing's on freaking fire. Just like the market is. These things, you know, they do better as the market does better. But also the weird thing about covered call funds is they also have an element of them that does better as the market pulls back too. It's one of the reasons why they're such badass funds. All right, so now let's go on to the next badass fund, IWMY. I hate this freaking thing. All right, IWMY. So they sold options Thursday night and they didn't cover them Friday morning. So they're still, or Friday afternoon. So they're still alive. So they sold the 21.45 strike. So what does that mean? It means we want the prices to be over 21.45. Okay. Well, right now it's 21.58. So what does that mean? They are over, right? So there's 0 points in the money. They're actually out of the money, which is what you want when you sell options. So we just copy this formula down. They're going for 1.1 million and they're realizing 1.1 million at this point in the day, 4 hours left. These guys are just murdering it. Look at this. They're up 5 cents a share. Okay. Yeah, not great, but they were down $1.49 2 weeks ago. They were down 85 cents a few days after that. They were down $1.04 a week ago. They were down 70 cents 4 days ago. It's just 4 business days ago. These guys are on freaking fire also. Okay, so let's go to USO right now. I just remembered I forgot to draw profit boxes this morning, so we'll just look at the sheets. All right, so USO, this one's a little more complicated. They sold 1,600 options Friday that expire Wednesday. They used the 77 strike and they received $1.38. Okay, so that means for this trade, they want the price of USO, which is the underline, to be north of whatever the strike was, 77. Okay, so right now, USO is trading at 75.36. So that creates a little problem. The reason it says 0 there is I don't calculate the in the money percent. I mean, this option is losing money right now, but it still has 2 days to expiration. I guess we could figure it out real fast. So what you want to do is you want to subtract the strike price, which is 77, or subtract the USO's price, which is 75.63, from the strike price, which is 77. So what does that equal? $1.37 or $1.27? No, $1.37. All right. So that equals $1.37. So if this was Wednesday afternoon, this would be a loss. Well, it actually would still be a small profit. Out of the 221,000, they would still realize 16,000. And why is that? Well, because they sold the option for $1.38. And in the scenario that I presented, it'd be worth $1.37 right now. So anyway, and the reason they make $1,600, look at that. Think about that. Well, how many contracts do they have? 1,600. Okay. Well, in options, 1 point is worth $100. Right? Okay. So they're trying to think how to describe this. Bit off more than I could chew. Actually, okay, yeah, I can explain real easily. You sell something for $1.38, right? You sell it short. That means you're short from $1.38. It means you profit if the price goes down. You cover it in my scenario at $1.37. So it's a 1 penny gain. Okay. So in options, everything's in terms of hundreds. So 1 penny equals $1. So it's $1 gain, right? Well, how many contracts do these guys have? They have 1,600, right? So they made $1,600 in this scenario. And that's before, transaction cost and stuff. But I just want to explain how that works. That's literally how they price options. It's everything. Option price is 1 is equal 100, or option units, let's say. So these guys also on Friday, they sold another 83 options. They probably got some money in late in the day, and they sold these at the 78 strike price for $1.69. Anyway, so let's calculate this right now. How many points this thing's in the money? So what do? We subtract the current price, 75.43, minus, that thing's dropping. All right, minus 78. So what does that equal? So it's 243, 247? Is that right? No, 257. So just even though these numbers aren't official, we'll just project what would happen if this thing closed now. That would be a loss. They're going for $14,000 on this trade. That would create a loss of about $7,000, right? Okay. What's 7,000 divided by 1,600? I'd say 4 or 5, right? So that's a 4 or 5 cent. Oh, no. I'm sorry. Wait. Let's think about that. Well, we'll do more math examples later. All right. So now let's look at Tesla actually, let's look at USOY. So I updated the dividend estimate. It was $1.40 all week last week. This time I bumped it to $1.50, and I know that's kind of high. Please, especially on this one, don't anyone go out and buy it just because they think this thing's paying $1.50. It could only pay $1. It could also pay $2. This should be somewhere close, but I'm not as experienced at predicting these as I am the triple QY. Triple QY and JEPY and IWMY are super easy to predict because they sell one option a day. It's just easy peasy. The math's simple. This, they use multi-day options, so you have to project how much they would make over the course of a month. Some options, they have 2 days of time on them. Some have 3 days. So the formula is not as straightforward, but I think $1.50 is close. Okay. So now let's see what else we should look at. Let's look at the market real quick. Let's just kind of see what's going on. I know I didn't draw profit boxes, but usually when we look at the profit boxes, we kind of get an eye on what the market's doing. So let's look at kind of some of the main funds. So we'll look at SPX. Well, look at this. They got outside their Bollinger Band at 8:30, and then they're still outside it. So anyway, that's pointing to trending up, which is what they were doing Thursday. Or Friday. It's what they were doing Thursday. They've been giving trending signals even as far back as August 24th. Of course, at this point, no one believed it was going to go up. But all right. Anyway, SPX looks good. So that means JEPY will be looking good. We'll look NDX. Now, NDX is the NASDAQ. This is what triple QI trades. All right. Nice job there. Now, actually, the NASDAQ, their profit boxes, I do have them drawn because it's a 2-day profit box. All I have to do is just extend it out another day. All right. So we do have profit boxes on that one. And let's look at IWMY, which is Russell. IWMY trades Russell. Same thing. We can just drag the profit box out, make sure it's level, flush, square, whatever. Okay. All right, so we see what kind of work this index needs to do. It can't drop below the top line, or it really can't drop below the bottom line, or there's going to be a trading loss on the day. All right, so let's look at USO. This is underlined for USOY, and yeah, okay. Now, so this thing, their profit boxes are still alive. Well, let me think about that. So this trade right here expired Friday, but then they wrote a new option. There was a 77 strike price for, I think, $1.39. Oops, that's no good. So what we do here is we start the profit box at 77 because that's the max profit. Close enough. 90 off by 2 cents. Okay, so then we drag it out till Wednesday because that's the expiration day of these options. So Wednesday at 4:30 or 2:30. make sure it's level. And then we pull the line down. How far did we pull the line down? We pull the line down 1.38. Why would we do that? Well, because that's how much the option we receive for the option. So that's how much buffer we have. So that's how much ground we can lose on the strike price before we start having a trading loss on it. So $1.38 would be 75. What was that? 67? I forgot already. Yours. Close enough. That may have been a little too big. All right. But anyway, we get a general idea of what kind of work the market needs to do. If you're a visual learner, you can say, okay, the market going from there to there, it's no big deal. But you can see kind of visually how much protection the trade has in it. Then there was also, they wrote 68 contracts on the 78 level. So we'll put that one back in there too. So we start at 78, right? This one's not going to be to scale because if I made this one to scale, it would invade the other profit. I guess we could do that. Okay, so what did they receive for this one? They received a lot more for this one. So let's look back here. They received $1.38 for the first one, $1.69 for the second one. So what is 169? So that's 7. So it's 76.31. Is that right? Or 41? 76.31. All right. So then I go over here and make sure this comes down to the 76.31 level, right? A little bit too far. Okay, well, you guys get the picture. So those are the profit zones for USO. Okay, so now let's talk about some. Let's look at the yield max ones real quick. I haven't been doing profit boxes on those lately. I apologize. I really don't think people watch me for yield max information. But I'm interested in yield max primarily because of the delta neutral trade. They have all these inverses coming out, and I'm going to have some new content on them. So that's my primary interest in yield max. I've never was a big fan of the single stock covered call funds because they're so much more risky just by virtue of being based on one stock instead of 100 stocks or 50 stocks or even 25 stocks. So that's why I never really have spoke that much about them. I think they're too risky, or they're too more risky than they need to be. I don't know why investing in Tesla or Nvidia, somebody just went by QQQQI or QQQY or JEPQ or whatever, or FEPI or whatever NASDAQ fund with some diversity. Diversity is our strength in trading. I don't care about, what you think about diversity outside of here. In trading, it is damn sure your strength. I promise you. I've been doing this my whole life since I was 20. All right. Diversity is what you want. However, I will say this. If you use less diversity, that's fine, but you're taking more risk. But yes, so these funds that only are based on one stock have the ability to perform better for sure, but on average, they're going to do worse because they're just based on one stock. But yeah, if you want to know which one's going to have the best return next year, it's probably going to be one of the single stock ETFs. Okay. If you want to know which one's going to have the worst return next year, it's definitely going to be one of the single stock ETFs, kind of like Tesla was last year. Okay. So sorry about no profit boxes on here, but let's just look at the charts and see what we're doing. All right. Tesla's going up. I look at this 200 period moving average is the way I separate if I'm biased towards the long side or biased towards the short side. Whenever it's underneath the 200 period moving average on whatever time frame you trade, which for my case is a 30-minute bar chart, that's a sign that it's not a good sign. And you can see for a couple of days it went down till we made the low, but then recently it's crossed back above it. So that's more of a bullish indicator, of course. So let's look at the last time it was underneath and then crossed above. Okay, the last time it was underneath for any significant period of time was back here. It went underneath for one day there, but any significant period of time there. Okay, so when it crosses back above that red 200-day moving average, it does that around 163, 165, something like that. Well, within a day, it's at freaking 200. Then it comes back down, but it still never gets as low as 160 and never. The lowest it got there is 167, and then it trended up. Well, you could look at this one too. It got underneath the moving average for those couple of days there. Okay, well, when it crossed the back above, it was around 176. It hasn't seen that price again. It's gone. It's boom at 176 to 270 in a few days. That's crazy. All right. Well, anyway, we could be getting the same kind of action again here or not, but I mean, it's something to consider. Okay, so let's look at NVIDIA. All right, I'll look at NVIDIA. 200-period moving average is one of many things to look at, but it's something like back over here. They were underneath it for a couple of months. It looks like they got above it there, but that was a false signal. It doesn't always work. They got above it there. They got above it here again. So it had two false signals first, but then when it got above it here, it was at 86 and it hasn't been back. Or, well, I should say that. But by the time it went underneath, indicating that maybe the bear market's coming, it's $1.21. You can make a lot of money between 81 and $1.21. You know, if somebody was trading this, if somebody was buying options. Anyway, then it kind of went back above and kind of, you know, anyway, we could see what it's doing. I mean, this thing's on fire. They're all on fire. This has been a great year for the market. One of the best years in a while, but not as good as last year was a great year too. Gosh, damn, last year was a great year. All right. What else should we look at? Let's look at Coinbase. Coney is the high yield fund, and there's even an inverse fund. Now look, so this is interesting. Been underneath that would have been a great sell signal right there. So it went from 230 to at a low 160. But anyway, now the market's meandering back around and is trying to get back above the 200-day moving average. When and if it does, look out. That's what I say. All right. So what else should we look at? Let's look at I'm going to answer some viewer questions and talk about some interesting stuff if you'll stick around for just a second more. What's the other one? Let's look at Misty. Gosh darn it. My apologies. All right, so just on the 200-day moving average, you can see the last time it was well below. It isn't below now, so it hasn't reset. But it gave a high signal, you know, around 30 or something, and it never crossed back underneath the 200-day, and now we sit at 130. Okay, trend following strategies can be that's called a trend following strategy, and those can be very powerful when the market's trending. Okay, so now let's check out AMD. All right. Boy, these things are on fire. I mean, even when it got below the 200-day, it gave a false sell signal there. But boom, if you take the next buy signal, you know, it's long at 109, goes up to 227, pulls back, and then finally gives a sell signal at 146. You can make some pretty good money between 129 and 146, even just following these simple trend following strategies. Right now, it looks like it's trying to reset and get back over it. Will it be another extended rally like this one was? Who knows? We'll watch it. So Bitcoin determines what a lot of these are doing. So let's just kind of look at Bitcoin and see where it is in relation to its 200-day. It recently gave up its 200-day, well, and then it went back above it, and then it gave it up again. So this market is doing what we call chopping. It's going back and forth, back and forth. If you follow a trend following strategy, like I'm showing you guys here, the 200-day moving average, or there's jillions of them, and you get involved in a choppy market, you're going to get your head ripped off. Why? Because it gives a buy signal there. It doesn't go anywhere. Then it comes down and gives a sell signal here. Watch, by tomorrow, it'll be a buy signal again. So you're just, that's just called chopping. Ideally, you want it to be under the 200 moving average for a couple of weeks or whatever. Then when it gets back above, boom, that's your buy signal right there. And what was that at? That was at $30,000 back on Friday, October 13th, or Monday the 16th. That's about the low of the market too. Anyway, but someone who bought Bitcoin that day, it went from 30,000 to 74. Then by the time it came down and gave you a sell signal, even though it was a false sell signal so far, 57,000. Make a lot of money between 37,000 and 57,000, right? Okay. So now let's look. I wanted to go over some channel news. I wanted to go over some comments I got on some videos, and maybe I was going to, instead of answering all of them, I thought I would answer them here. We could talk about them. I thought that might make some a good topic for today. So let's talk about this for maybe 10, 15 minutes, and I'm going to let you guys go. All right. So, and I have a big announcement, but stick around till the end because I have a big announcement about two fund manager interviews that are coming up. One of them you know about already, but one of them I've never told you about. So if you want to watch that, you have to stick around and listen to me talk about KQQQ. All right. Well, let's see. People are answering old videos, so that's fine. I was saying in this video right here, I don't know if you guys saw this video, YieldMax files for 6 not so high yield ETFs, but they should catch hella upside. Okay, this guy was reacting to that video, and I was saying, we're in a bubble for covered call funds. He was kind of agreeing with me and saying it might be time to pull my YieldMax because there's too many ETFs out there for sure. That's not what I was trying to say. I respect his opinion or whatever, but I'm trying to say that it doesn't matter. There can be as many of them as they want. They're ETFs. They aren't based on supply and demand. They're more like a hedge funds that you can invest in. So I didn't mean to say that there's too many. But what I am saying is there's too many and people are too in love with them. There's too many people. Maybe these are right for 30% of America, and maybe 50% of America is buying them. That means there's 20% of people that are buying them that have no business buying them. A lot of the bad comments you see on these come from that phenomenon, I think. But anyway, there's a lot of them. I do think it's a bubble, but I'm not predicting an imminent crash, is all I was saying. That's all I said. Okay, so this person said it didn't work, complete failure. I don't know what he was referring to, but I think he's probably just one of those guys that doesn't like covered call funds. I was talking about YieldMax mainly, so he's probably referring to YieldMax. All right, so this person, okay, how's the NAV? Okay, so this was just from Friday's update. So let's read what they said. How's the NAV? I had all the Defiance until the NAV dwindled and it had the reverse split. Sold and bought Roundhill for weekly dividends. I'll watch them, but I sure got shellacking. I had owned them for some time between the NAV erosion and the reverse split. I'd have enough of a loss. I have YieldMax, FEPI, and others. Thank you for your great review. All right. Yes, you're certainly welcome. I just had a comment on that. I just had a quick comment on that. Let's look at something. All right. I need to do one thing here. I need to do this and then do this and then share the entire screen. Okay. Yeah, let's talk about that. So this person was saying that they had a loss or whatever. I don't see how that happens. I think their definition of a loss and mine are different. Triple QY, let's see, or we'll do the S&P one. Let's do JEPY. That one doesn't even do as well as Triple QI, but let's just look at the S&P one. So, so here's how it works. So if we bought this one the day it came out, we would look at the total return. We're up 11%. Okay. I don't know how anyone could lose money on this. Maybe if you bought it right at the top, like a month ago, and you might be down now, but anyone who's had this for any period of time is up money. Now, I will say this. A lot of people that don't understand how these funds work, they'll say, well, it underperforms the SPY. Yes, that's true. Very good. It's designed to underperform the SPY. That's the way it's designed because it's an income fund. It's also designed to outperform the SPY. Okay, there's two dimensions to this fund. There's the NAV and there's the yield. And the yield beats the shit out of the SPY. Look at this. This fund right here, look over at the same time period as someone about the SPY. You go buy the SPY. That's fine. Have fun. You go buy the SPY. I'll buy JEPY. Okay. I got $21 in dividends on a $60 investment. Think about that. You got $5 in dividends on a $500 investment. Okay. All right. The dividends are what impedes the paying a dividend is what impedes the NAV growth. So the bigger dividend you pay, yes, you're going to have less NAV growth by design. That's the way it works. So why is my number one rule on this is don't buy these funds unless you need income. And I don't mean that you want income because you want to be wealthier. I mean that you need income because you're unable to work or because you're retired or for some other reason. Okay. Or lots of people use income to diversify their portfolio. They might have 70% growth assets and stocks and maybe 30%, income producing assets. So it could also be used for diversification. But yes, so if you don't need income or diversification, no, don't even touch this. Go buy the SPY. Because what does the SPY give you? The SPY gives you better total return, right? Okay. But so does that mean that the dividend funds, the high yield dividend funds never have more total return than the non-dividend funds or whatever? No, not necessarily. But in SPY's case, that's what it means. Let's do this. So a lot of people are just in love with this fund by JP Morgan called JEPI, and it is a good fund. It does basically the same thing, except they use monthly options instead of daily options. But it's similar in many aspects outside of that. So let's see. So how JEPY did. Oh, look at this. JEPY beat the shit out of JPI. Well, why is that a big deal? Well, let's look here at the dividends. JEPY paid $21 on 60, right? Okay. JEPI paid $4. We'll call it on 55. Jesus, really? Okay, so JEPI had a tiny dividend and did worse on total return. Just because you pay a big dividend doesn't make your total return bad necessarily. You'll beat some other investments and you will lose to some other investments. In this case, I mean, JEPY is a great fund. And I mean, and they're doing really well against this fund. And they're getting the same total return. Look at this, 11.33, 11.3. We'll call that a tie. But they're getting way more dividends. It's best of both worlds situation. Now, they all don't work like that. Some high yield funds do worse than other funds that have a little bit of a lower yield. But that's a good example of when these funds work. Now, let me give you a contrary example. Or it's not when they work. That's the wrong thing to say. They work like they're designed to work. But let's give an example of when a fund that pays less dividend also does better on NAV. So we're going to look at QQY. This is the NASDAQ Defiance Fund. They sell daily options. We'll compare it to JEPQ. That is the Morgan Stanley, or I'm sorry. See, who is that? It's Jamie Dimon's company. I've totally drawn a blank on it. JP Morgan. It's even in the initials. JP Morgan. So they do the same thing as JEPI, the one we just compared to, except they use NASDAQ. Okay, so let's chart $10,000 here. Okay, well, in this case, I always look at the bottom one. The bottom one is dividends not reinvested. Dividends reinvesting is kind of cheating and it kind of skews the results in my favor. Even though it's a good thing to do in real life, we don't want to look at results based on dividends reinvested. We want to look on results, just cash on cash return. Okay, so in this case, QQY paid $27 in dividends on $60. Think about that. That's monstrous. All right. Well, these guys paid $4 on $48. Okay. Well, that's pretty good too. Don't get me wrong, but I mean, so this is an example. JEPQ is an example of because they paid less dividends, they do have a little more total return. There's a 4-point differential in total return, but it's not a given that the fund that pays more dividends is going to do worse in total return. All right, so let's look at some other questions. Okay, so I didn't want to just read all these, but I had a few that I wanted to drill down on. What is the deal with these people? My CFA, Nicole Anastasia Plumley, renewed. Gosh, these are scams. I just report those. Unwanted commercial spam. Yeah, definitely spam. Correct. All right, guys. All right. So let's see. What else there were some other good ones on here. This guy was asking me a question about profit boxes. Okay, he says, "Hi Max, I'm glad you're back from vacation. I miss your program. Today I learned something new about this profit box. I wonder if you can explain how they calculate profit. If puts is in the profit box somewhere in the middle, can you explain?" Yes, I can absolutely explain this. Okay, using this morning's example of the 78 strike and the puts $1. Okay, let me just try that on my own. Okay, so we're going to go to USO because I just did this profit box and it should be fresh in our minds. So we did these two profit boxes. Okay, so what he's saying, let's put it back on 30-minute chart. What he's saying is at the end of the day, if it lands in the middle of the profit box, what's the profit? How do you figure the profit? So let's start back at the beginning. So if it lands on the top line or above, it's max profit. So whatever they sold the option for, they realize all of it. So in that case of that option, they sold for $1.39. If it closes over the top line of whatever the strike price was, boom, $1.39 profit times 1,600 or however many contracts they have times 100, right? Okay, yeah. All right, so if it closes at the bottom, it's actually break even. Okay, and why is that? Because they sold this option for $1.39. Well, I put the bottom line $1.39 away from the top line. So that's where a loss starts. But he want to know in the middle. In the middle is a good one. So let's say instead of closing at 78, it closes at 77, right? So it closes, that's what we call that 1 point in the money. Because we sold the option, but when you say in the money or out of the money, it's from the perspective of the buyer. And I know that's kind of confusing, but and it's because retail buys options and you hear people say in the money and stuff. It usually means it's a retail thing to say. All right. But let's say, so this one's at 78 and then on expiration date, it's at 77. I'm just doing that because the math's easy. Okay. So let's go back to this. Okay. So we'll just go on this line where it said $1.37. I'm gonna blank that out. We're gonna pretend like it's Wednesday, and we're gonna pretend like this thing that was, well, pretend like it's a 77 strike one. We're gonna use 76. All right. So that one, the 77 strike one, it closes at 76. So what we do is the computer, what it does, I used to put the closing price right here, and it would spit out the points in the money automatically. But I quit doing that. But anyway, so now I just do it manually. So 77 less 76 is $1 in the money. Okay. $1 in the money. Okay. Is going to be only a $60,000 gain instead of a $220,000 gain. If it would have closed out of the money above 77, it would have been a $220,000 gain. Okay. At 76, it's a $1 loss. Anyway, so how do we get that? So why does $1 equate to losing $150,000 or $160,000? 159 too is what that equals, I believe. All right. Well, how does that happen? Well, okay. So they lost $1. Okay. So it's $1, but option prices are in what? Hundreds, right? So they actually lost $100, not once per contract. It's $100 per contract. How many contracts they have? Well, they had 1,600. So they lost $1,600 per contract. 1,600. Yes, that's it. They lost $1,600. Well, wait. I got mixed up. Okay. They lost $1 per contract. That's $100 per contract. There are 1,600 contracts. So that's 160,000 is what they lost. What's 160,000 minus 220,800? Yeah, that's what it is. There's that. All right, nice. See how that works? Now I'm going to let's just put the real price back in here. Usually what I do is I leave these blank until we actually know where these settle, because these options have another day and a half. All right. Well, anyway, I hope that explained that one. I had one more that I really wanted to talk about. So let me just try to find it. Now, I'm going to answer that one in another video. Okay, we just answered Mark's questions about how you figured the loss. If I wasn't clear enough, I'd be happy to help you one-on-one. Mark or anyone else, hit me up in the messages and we can figure something out. But I love talking about this stuff. All right, so what did this guy say? This guy said, oh, okay, yeah. This is a great one. This is the last one I wanted to talk about. Actually, I got one more after this. It said, morning. Considering Triple QI had a 3-for-1 reverse split, should the new dividend amount have been adjusted 3x what it was? So from 83 last month to around 249 this month. Correct. That's right on the money. That's how you figure dividends. The problem is the dividends on Triple QI vary every month. It's not 83 cents a month. It's not like a stock where the company has a board meeting and they declare a dividend of 83 cents. Okay. These are more like hedge funds or trading companies. At the end of the month, they take up how much money they made selling options. They divide it by how many shares they have and they give it to the shareholders. So it's a totally different deal. So yes, but it should go up 3 times, other things being equal. So if this next month, if they made the exact same amount of money they made last month, it would be exactly, it'd be 83. And let's say they had the same amount of shares. The math was the same. Yeah. Dividend be 249. Great. Okay. Well, this month they're about, let's go look real quick. Let's see what they're doing. They're just murdering it this time. All right. So their dividend estimates $1.25 in the old numbers. All right. So what's $1.25 times 3? 375, which is the new number, right? Okay. So, but the amount they're able to make varies. It goes up and down all the way till the end of the month. Okay. You could see the amount they make every day because it's the amount they make, they pay the dividends with comes out of this column that says extrinsic. They made 700,000 that day, a million, $1.4 million, $1.3 million, $1.5 million, $1.2 million. They add all these up. You add all those up. How much extrinsic they capture, which is the out of the money portion of the premium, not the in the money part, the out of the money part. You add all that up and divide it by how many shares you have, and you come up with that number, 376. Well, then I just extrapolate it to make it for people that are used to thinking in terms of the old number. I'll probably quit doing that in a couple of months. I know that's confusing. But yes, other things being equal, the dividend should be triple. Now, here's something that happens sometimes. Let's say they have a worse month. Let's say Triple QI, they paid 83 cents last month. This month, volatility goes down. They aren't able to capture very much extrinsic income, so they pay less, right? So let's say they made 83 cents a share the last time, and that's what they paid out. Let's say this month they do about half as well. So they just capture 40 cents in extrinsic. Okay. Well, so that's what they pay out. They're going to pay 40 cents out. Okay. But in the meantime, they've had a reverse split, a 3-for-1 reverse split. Okay. Well, so what are they going to pay now? 40. That's what they actually would have made in old shares times 3 to make the new shares. They pay $1.20. So then whenever something like that happens, and it happens occasionally, I'll get comments like, I thought you said they were going to pay triple the dividend. They're going to pay triple whatever the dividend is based on, but I can't predict the future, and it could be more than triple, but it could be less than triple because it depends on the results during the month after they split it. Other things being equal, it should be triple though. All right. Let me know if that's not clear enough or if you disagree or whatever. I argue with people about that one all the time. A lot of people just don't understand how it works and just don't agree. They just don't agree. But every time I have a fund manager on here, I ask them that question. I ask Jay that question. I try to get as many people to know what they're talking about on record, explaining it that way to back it up. All right. One other thought here real quick. One other thought. Content. I wanted to explain myself on this one. The yield max files for 6 not so high ETFs. So let's look at comments from that one. All right. Well, yeah, Norman. I like Norman. Thanks, Norman. Nice comment. Appreciate that. That's not what I want to talk about. I don't know why it's not. Oh, hang on. All right. This one I didn't understand, so I thought I wanted to explain. All right. So Publish help for you. Well, I can't find the one I wanted to talk about. Maybe the customer deleted it or something. I don't know. Well, anyway, that's fine. That is fine. Maybe it's not here anymore. Okay. Well, very good. Let's take a look into the market, see if it's moving. You guys get out of here. Let's look at NASDAQ. Kind of grinding, still over the profit box though. All right, guys, I'll let you get out of here. I hope you have a great day. Hey, don't forget if you'd like to support the channel, there's my PayPal at the bottom of the screen. I'd really appreciate it if you consider supporting the channel. Thank you very much. And like I say, if you have any questions, I try to answer most of them. So let me know. All right, guys, take care.